Imagine tiny molecular scissors going into our DNA, snipping out the bad bits, fixing the errors that cause disease. Sounds like science fiction, right?
Almost. But it's the reality of gene editing, and companies like CRISPR Therapeutics are right at the forefront.
Yeah, they promise to totally change medicine, maybe even offer one-time cures for some really awful illnesses. But here's the question for you listening. Can something this revolutionary be a revolutionary investment? Or are the risks just as massive as the potential rewards?
That's exactly what we're digging into today.
We're doing a deep dive into CRISPR Therapeutics, ticker CRSP. They're pioneers in this gene editing space. We're using a detailed report looking at their business, the science, the financials, and really importantly, how the market actually views them.
Right, and just for context, this analysis is as of July 8th, 2025. The share price then was $54.82. And just to be super clear, we're talking CRISPR Therapeutics AG on NASDAQ, totally separate from the academic CRSP, the Research Pricing Center.
Got it. Okay, let's unpack this thing. We'll go chapter by chapter, really get to the core of what you need to know about CRSP. All right, let's kick things off with chapter 1, business analysis. Is CRISPR Therapeutics building the future of medicine? So CRISPR Therapeutics is what they call a clinical stage biotech. What that means for you, thinking about investment, is their revenue isn't steady like, say, a company selling widgets. It's lumpy, unpredictable.
Yeah, most of their money comes from big deals with larger pharma companies. Think large payments up front when they sign a partnership, then more payments, milestones when they hit certain research or regulatory goals, and then if a drug gets approved and sells, royalties way down the line.
That big partnership with Vertex Pharmaceuticals is the key example, right?
Yeah.
That's what got their first therapy, Casgevy, over the line.
Exactly, Casgevy. Or Exactcell, technically. It's literally the world's first approved therapy using CRISPR gene editing.
Wow. And how does it work?
It's what's called ex vivo. So they take a patient's own cells out, edit them in the lab to fix the genetic problem, and then infuse them back into the patient. Right now, it's approved for sickle cell disease and beta thalassemia, serious blood disorders.
Okay, so that's the first big win. But what else are they working on? Their future growth must depend on more than just Casgevy.
Oh, definitely. Their pipeline is pretty diverse, broken into 3 main areas. First, immuno-oncology. They're developing CAR-T therapies for cancer. The twist here is they're trying to make them off the shelf.
Meaning not personalized for every single patient.
Exactly. Pre-made, ready to go. That would be a huge step up in access compared to current CAR-T. Second, and this is potentially massive, is their in vivo approaches.
In vivo, meaning inside the body.
Precisely. Using tiny lipid nanoparticles, LNPs, to deliver the gene editing machinery directly into the body with just an injection, their first targets are cardiovascular diseases.
Whoa, okay, so that's moving from rare diseases to really common ones.
That's the dream. Success there would just blow the market wide open. And third, they have regenerative medicine, focusing on things like type 1 diabetes, trying to create insulin-producing cells.
That's quite a range. So where does this put them in the market? They're obviously pioneers with Casgevy.
Undeniably leaders. Bringing the first CRISPR drug to market is a landmark achievement, but they're still a mid-cap company, market cap around, what, $5 billion?
Yeah, but $5.04 billion when we looked,
Yeah.
which makes them interesting, right? Huge potential on their own, but maybe also target for big pharma wanting to buy their way into gene editing?
Absolutely a possibility. And their core idea, their value proposition is just fundamentally different. They're not about managing chronic symptoms for life. They're aiming for one-time curative treatments by fixing the underlying genetics.
Which, if it works, could actually save the healthcare system money in the long run, despite the high upfront cost.
That's the argument. Avoid decades of chronic care costs. And the whole gene editing market is growing fast, projected to roughly double by 2032.
So, big market potential. But they can't be the only ones playing in the sandbox.
No way, it's intense. You've got direct competitors like Intellia, Editas Medicine, Beam Therapeutics. Beam is interesting. They focus on base editing, a different kind of gene editing.
And even their partner, Vertex, could become a competitor down the line, right?
Could be. Everyone's building capabilities. Quick comparison. CRISPR's at $5 billion market cap with an approved drug. Intellia, late stage, $1 billion. Editas, earlier stage, maybe $200 million. Beam, also earlier, $1.7 billion. So CRSP has the lead, but others are definitely in the race.
And getting these things approved, that's got to be incredibly difficult. The regulatory side must be a nightmare.
It's rigorous. FDA, other global agencies, the scrutiny is immense. which, creates a barrier for others. It's part of CRSP's moat. But it's also a massive risk for every single new drug they try to develop.
So that complexity, the IP, the regulations, the sheer cost,
Hmm.
that's their protection, but also their challenge.
Exactly. But they have other advantages, too. Brand strength is huge. One of their co-founders, Dr. Charpentier, won the Nobel Prize for CRISPR. You can't buy that kind of credibility.
Right. And Time magazine called them one of the most influential companies in 2025.
Plus, that $2.2 million price for Casgevy. Yes, it's huge, but they frame it as value-based. A cure versus lifetime costs. It's a whole new way of thinking about drug pricing.
And they're building expertise, like a platform effect,
Yep.
and controlling their own manufacturing.
Yes, that manufacturing control in Massachusetts is key for complex therapies like this. So, summing up Chapter 1, Casgevy wasn't just a product launch, it proved the whole platform works. That de-risks the science a lot, but that price tag, it's both the big opportunity and the big hurdle.
Okay, so the science is validated, but turning that into a huge, profitable business needs top-notch leadership. Let's move to Chapter 2, Management Evaluation, the architects of the revolution. Who's running the show?
The CEO since 2017 is Samarth Kulkarni. He has a PhD in bioengineering and nanotechnology. Crucially, though, he was also a partner at McKinsey, co-leading their biotech practice.
Ah, so he gets both the deep science and the business strategy? That seems vital here.
Absolutely essential. You need someone fluent in both languages.
And how's their track record? Going from basically a science project to an approved drug is impressive.
It really is. Under Kulkarni, they navigated those tough clinical trials, the regulatory maze. Remember that FDA advisory committee meeting that actually halted trading? They got through that.
Right, that must have been tense.
And making those big bets, like investing heavily in their own R&D center in Boston and the manufacturing plant in Framingham, that shows long-term vision, wanting control. Plus, their transparency, like publicly stating they're against germline editing, helps build trust.
Okay, and how do they handle their money? Capital allocation.
It seems disciplined. Focus is definitely on R&D reinvestment. They prefer partnerships like the Vertex deal rather than big, risky acquisitions.
And no dividends or buybacks, which makes sense for a company pouring everything into growth, right?
Completely normal. Expected, even. Every dollar needs to go into the pipeline right now. Their return on invested capital is negative, like Medica 12%, but honestly, that metric doesn't mean much yet. The returns are hopefully years away.
So ROIC isn't the number to watch.
Not really. You want to watch their cash burn rate versus how much cash they have in the bank. That's their runway.
Okay, it makes sense. Now, you mentioned Kulkarni's dual expertise. How does that play into their strategy for managing the huge risks involved here?
This is where it gets really interesting. They seem to use a barbell strategy.
Barbell, like in weightlifting.
Kinda. On one end, they de-risk the initial launch of Casgevy by partnering with a giant like Vertex. Shares the cost, shares the risk, gets validation.
Okay, the safe end of the barbell.
Right. But on the other end, they keep 100% ownership of the really high-risk, high-reward stuff, the next-gen platforms like CRT, and especially those in vivo therapies targeting common diseases.
Ah, so they keep the potential for the massive home runs entirely for themselves.
Exactly. It's a calculated gamble. Partner for the near-term stability, retain full upside on the potential blockbusters. Take someone who understands both the science potential and the market realities to pull that off.
That's clever. Balancing act. Okay, from the vision and strategy, let's get into the weeds. Chapter 3, Financial Analysis. The numbers behind the science.
All right, the numbers. Market cap, as we said, around $5 billion. Mid-cap biotech. Revenue? Highly volatile, event-driven. 2024 was way down, like $37 million, almost 90% lower than the year before.
Why such a big drop?
Because 2023 had some big milestone payments from Vertex that didn't repeat. The point is, you can't look at past revenue and predict the future here. It all depends on how well Casgevy sells now and hitting future pipeline milestones.
Got it. And profits. Margins.
Deeply negative. Gross margin minus 271%. That just shows how much they're spending on R&D. Their burning free cash flow is negative $272 million in 2023, for example. This will continue for years.
Okay, negative numbers everywhere, but you said that's expected for a company at this stage.
Absolutely. The crucial thing isn't the negative number itself. It's whether they have enough cash to sustain that burn.
Which brings us to their financial stability.
Yeah.
And this looks like a real strength.
It's their fortress. Debt to equity ratio is basically zero. They have almost no debt. And they have a ton of cash, nearly $1.9 billion as of the analysis.
Wow, $1.9 billion in cash and no debt.
Yeah, their current ratio is incredibly high, meaning they have tons of short-term liquidity. That cash pile is their financial moat. It buys them time to get those pipeline drugs developed.
So financially stable, but not profitable? How do you even value a company like this? Standard PE ratio is useless, right?
Totally useless. It's negative. The industry standard is something called a risk-adjusted net present value model, or RNPV. It's a specialized DCF.
Okay, break that down simply.
Basically, you try to forecast the potential sales of each drug in their pipeline, estimate the costs, and then, this is key, you discount those future potential profits based on the probability that the drug actually makes it through trials and gets approved.
So a drug in early trials gets discounted much more heavily than one nearing approval.
Exactly. Phase 1 might only have a 10% chance factored in, while an approved drug like Casgevy might get an 80–90% probability. You add up the present value of all those risk-adjusted potential drugs.
And what does that RMPV model suggest for CRSP?
Based on the analysis, running an educational model with reasonable assumptions gives an intrinsic value range of roughly $45 to $75 per share.
45 to 75. And what are the big assumptions driving that range?
Things like the discount rate, you use a high one, maybe 13–15% because it's risky, those probabilities of success. Peak sales estimates maybe $1.5 to $2.5 billion for Casgevy eventually, and potentially much bigger numbers, $1 to $5 billion plus, for the pipeline drugs if they hit common diseases, and of course, estimating costs.
So, Chapter 3 takeaway.
Yeah.
Valuation is tricky, very sensitive to assumptions about future success, but their balance sheet is rock solid, giving them runway.
Seriously, that cash is king for them right now.
Okay, we've looked inside the company. Now let's look at how the market views them. Chapter 4, Market Sentiment, Hype versus Reality.
This is where it gets really dramatic. Analyst price targets, generally positive. Consensus is often moderate buy or buy. Average targets sit somewhere between $70 and $81.
Okay, sounds bullish.
But look at the range of those targets. It's huge. Lows down at $32 or $35, highs up over $100, historically even way higher. That tells you there's massive disagreement and uncertainty.
A wide range signals uncertainty. What about the general buzz, the media?
Overwhelmingly positive. Revolutionary science, Time 100 most influential companies. The story is incredibly bullish, but there's a clear disconnect between that narrative and the less glamorous financial reality of cash burn.
Right. So story versus numbers. What are the hard market indicators saying?
Okay, here's a big one. Short interest. It's extremely high. We're talking 23, 24, almost 26% of the available shares being shorted.
Whoa. Anything over 20% is usually seen as a major red flag, isn't it? A lot of sophisticated money betting against the stock.
Exactly. It makes CRSP a classic battleground stock. Huge debate between bulls and bears.
But then you look at the technicals.
Right. The price, $54.82, is actually trading well above its 50-day and 200-day moving averages. That's usually a bullish signal, suggesting strong positive momentum.
Total contradiction. Analysts mostly positive, but with huge disagreement. Media loves the story. Technicals look good, but a massive chunk of investors are betting against it.
It's a perfect storm of conflicting signals. You have the story investors focused on the long-term potential clashing head-on with the reality investors focused on the current financials and hurdles. This setup basically screams future volatility.
Fascinating.
Okay,
if the market is so divided, who actually owns the stock? Let's look at Chapter 5, Ownership Structure. Who holds the keys?
Institutions dominate. Big funds own somewhere between 68% and 77% of the company. The single biggest holder is ARK Investment Management, Cathie Wood's firm, with around 10 or 11%.
ARK is known for betting big on disruptive tech, so that makes sense. But having so much owned by growth funds, can that add to the volatility?
Definitely. If a few big funds decide to sell, it can move the price significantly.
Okay, so institutions are big believers. What are the insiders? The execs, the board members, the people who really know what's going on.
And here's the stark contrast. Insiders own remarkably little, less than 1%, maybe up to 1.7% tops.
That seems low for a tech company.
It is low. And what's more concerning is the pattern of their trading. Over the last 12 months before the analysis date, there were 23 insider sell transactions and only a single insider buy.
23 sells versus one buy. Wow. How many shares are we talking?
Net, over 236,000 shares sold by key executives. That's like, well, it's a pretty significant bearish signal coming from the people who should know the company best.
So the people closest to the action are selling, while big institutions are buying. That's quite a divergence.
It's striking. And adds to the concentration issue, the top 14 institutions control over half the company. So a few big players have a lot of sway.
So Chapter 5 leaves us with this paradox. Huge belief from outside institutions, but what looks like serious caution, or at least profit-taking, from the insiders. Another sign pointing towards potential volatility.
Absolutely. The ownership structure itself seems built for swings.
All right, every investment has risks. For biotech, they can be huge. Let's map them out in Chapter 6. Risk assessment. Navigating the unseen. Maybe start with a SWOT analysis. Strengths, weaknesses, opportunities, threats.
Okay, sure. Strengths. Obvious ones are the pioneering tech, the Nobel Prize connection, Casgevy, proving the platform works, that fortress balance sheet, almost $2 billion cash, no debt, the diverse pipeline with huge potential, and those key partnerships, like with Vertex.
Makes sense. Weaknesses.
Still not profitable, burning cash fast, huge reliance on clinical trial success failure is always a risk. And the big one, proving they can actually make money selling a $2.2 million therapy at scale. That commercial model is unproven.
Right, the commercial challenge.
Yeah.
Okay, opportunities.
Expanding Casgevy to more patients or conditions, moving into those huge common diseases, cardiovascular, diabetes with the in vivo platform, that's where the exponential growth could come from, and just continued innovation in the gene editing tech itself.
And the flip side, threats.
Intense competition. We talked about Intellia, Editas, Beam's base editing. New tech could always emerge. Regulatory hurdles, and especially reimbursement, getting payers to consistently cover that $2.2 million price tag. And, ethical concerns or negative public perception around gene editing are always lurking.
Beyond the company specifics, what about bigger picture risks, macroeconomic or geopolitical?
Yeah. Those matter too. High interest rates are bad for valuations of companies like this, where profits are far in the future. It also makes M&A potentially harder. Drug pricing pressure, like from the Inflation Reduction Act in the U.S., adds uncertainty.
And geopolitical. Supply chains.
Definitely a risk.
Yeah.
Global supply chains are complex. Things like tariffs, the report mentioned, potential 2025 U.S. tariffs on e-China imports could raise manufacturing costs or disrupt supplies.
So putting it all together for Chapter 6, it feels like the type of risk has shifted for CRISPR Therapeutics, doesn't it?
That's a key insight. Initially, the big risk was scientific. Can this CRISPR thing actually work safely in humans? Casgevy answered a big part of that with a yes. Now, the dominant risk is shifting to be commercial. Can they successfully build a profitable business around these incredibly expensive, complex therapies?
Plus those external pressures from interest rates and global trade tension squeezing them.
Right. The challenge has evolved.
Okay, we've covered a ton of ground. Science, management financials, market view, ownership, risks. Let's try to synthesize it all in our final section. Chapter 7. Conclusion.
All right, let's lay out the bull case clearly. Why might you invest? 1. Validated, pioneering platform tech, proof of concept with Casgevy. 2. Huge potential markets if their pipeline hits common diseases. 3. That rock-solid balance sheet, the cash runway. 4. High barriers to entry, creating a moat. 5. Visionary, proven leadership that understands both science and business.
Okay, strong points. Now the bear case. Why might you stay away or even bet against it? 1. That unproven, super expensive commercial model for Casgevy. 2. Extreme valuation for a company still burning cash and years from consistent profit. 3. Intense, evolving competition. 4. Those worrying signals, high short interest, lots of insider selling. 5. Macro headwinds, interest rates, potential tariffs, pricing pressure.
And recapping the valuation, that RNPV analysis suggested an intrinsic value somewhere between $45 and $75 per share.
Right. And the share price, when this analysis was done, $54.82, falls smack in the middle of that range. Which really sums it up, doesn't it? The market is basically acknowledging both the huge potential and the huge risks.
Exactly. It's priced for uncertainty.
So the final outlook. An investment in CRISPR Therapeutics is clearly a high-risk, high-reward play. You're betting on brilliant science and skilled management navigating incredible complexity, but you're betting against significant commercial hurdles, tough competition concerning market signals, and broader economic pressures. Volatility seems almost guaranteed. Success requires not just scientific breakthroughs, but near-flawless execution on the business side, too.
Well said. It's a fascinating but complex story.
Thinking about this, a $2.2 million one-time cure like Casgevy, it's not just a business challenge for CRSP. It forces us to ask bigger questions, doesn't it? Like, how do we make sure everyone who needs these potentially life-saving treatments can actually get them? Is society or are our healthcare systems ready to handle these incredible but incredibly expensive breakthroughs? Something to think about. Well, that was a seriously deep dive into CRISPR Therapeutics. We really hope drilling down into the details like this helps you feel more informed. And hey, if you found this valuable, please do like this video and subscribe to the Stock Analytics AI YouTube channel. For just $4.99 rent a month, members get priority requests for deep dives like this one. We're planning to cover all the S&P 500 stocks over the coming months, and members get first crack. Or, if you just want a one-off analysis on a stock you care about, dropping a super thanks is a great way to support the channel and request it.
And the important reminder, this analysis was generated by an AI system. It's for educational purposes only. It is absolutely not financial advice. Always do your own research, and please consult with a qualified financial advisor before making any investment decisions.